By now, you should have a clear understanding on what a mathematical edge is, and hopefully now understand how to calculate probability and profit expectancy. You should also be familiar with the concept of the law of large numbers and realize that the underlying profit expectancy of any event will play out over a large number of trials. We have discussed how the casinos make money over time, as they are the masters of the world at exploiting their slight positive edge, and how futile it is trying to predict the outcome of each individual game. You've also learned the 4 core elements that make up the edge of a strategy and how to use these to develop a trading strategy that has a positive expectancy. And we've seen how you can be wrong far more often than you are right and still be highly profitable. And then in the previous lesson, you learned about the 2 trading profitability models, high strike rate and high reward to risk. So at this point by now, you would be completely forgiven for thinking, if all I have to do is find a good strategy with a slight edge and trade it as consistently as a casino spins the roulette wheel, then why isn't everyone doing it? Why isn't everyone making money this way? And that's when we loop back around to the mind game. The mind game is the trading game. And to understand how successful traders think, we must first understand how the majority of traders, the masses, the losing 90%, we must understand how they think. And then we're going to look at 2 mental models to help you think like a winning and successful trader. I'm sure we're all quite familiar by now with this diagram representing the 2 parts of the human mind, the higher mind and the lower animal mind. So let's talk about the polarities of skepticism and naivety in trading for a minute. So bringing your stuff into the market. Now, if your beliefs about trading are balanced, realistic and empowering, you will naturally have the greatest probability of success. However, if these beliefs sway towards naivety and infatuation, so you're thinking Forex is amazing, I'm definitely going to turn my 5k account into £1 million in just 6 months. It's easy. I saw some random guy do it on Instagram. I'm going to have a Lambo by Christmas, right? We've all heard these people before. Or, if these beliefs sway towards skepticism and resentment all the way to the other end. So thinking, Forex is an absolute scam. There's no way anyone can make money in it. It's all a lie. I hate it. If your beliefs sway between these 2 poles, then naturally you will lower your probability of success. The more balanced, realistic and empowering you can keep your beliefs, the higher probability of success that you will have. There's an interesting way of finding out where someone's mind lies between those 2 polarities of skepticism and naivety within trading. So down here on the bottom x-axis, we have the probability of a winning trade based on a reward to risk ratio of 1:1. So if you think that your probability of winning is at 0%, then that obviously means that you think you'll never win a trade. And if you think it's at 100%, then that means you think you will win every single time with a reward to risk ratio of 1:1, right? And we know that in trading, you can actually lock in a 1:1 reward to risk at the time of entry, even if you have no thought that goes into the trade, because you can just throw a dart at a dartboard, right? You can enter a trade at random and still lock in 1:1. You just set the profit target and the stop loss at an equal distance. And then you can only ever be stopped out for a 1% loss or a 1% win. It's a binary outcome with 0 skill required whatsoever. So then over on the y-axis, on the left-hand side, we have the number of trade setups per month, right? And it's in the log scale. So how many trades per month do we actually find at 0% probability of a win? And how many do we find each month at 100% probability of a win? And it goes up in a log scale, right? So the y-axis is getting infinitely bigger. So the point of doing this exercise, remember, is to find out where someone's mind is. Infatuated, naive beginners, they tend to lean towards naivety and they tend to think that they can win very easily. So the probability of a win, they start down here at 0% and they think, I know that some trades are going to be losers, but I'm a trading god, I'm going to win most of the time. And they have a scale, right, their mind scale that looks like this. This green line represents someone's mind on a scale of how naive they are about trading. But what do we know from the pendulum diagram before? When someone has gone into naivety, when they have a lopsided perception of reality because they are naive, you will bang your head against the wall of truth until it flips around to resentment. So naivety turns into resentment and skepticism. Why? Because you're going along in naivety thinking you're always going to win, but in truth, it doesn't happen, it never has, and it never will. And then you'll compare your true performance, which in reality, with a 1:1 risk-reward ratio, will be much nearer in the middle, around 50%, and you will compare that to a naive fantasy where you're supposed to win all the time, or even most of the time. So then you'll get pissed off and annoyed, and you'll start to completely flip around into resentment, and you'll overcorrect, and you'll have a losing streak of say 5 trades in a row, which is obviously completely normal. And you flip your mind and you think, I can never win. Trading is impossible. No one can make money consistently doing this. So you've literally just gone from I can never lose, I'm a trading god, all the way around to I can never win. And these, again, are the polarities of the losing masses. And the bigger that your misconceptions, fantasies, and naivety are with trading, the bigger that you will flip and swing. Go and look at the forums online or some of the activity on social media, and you'll see it firsthand. You will see the polarities in trading. Some people are so infatuated with trading. They really think they're going to make millions and get rich tomorrow. They think they're going to quit the job and be a full-time trader in just a few weeks or months. And then some are so resentful. They're so skeptical. Fuck trading. It doesn't work. I tried this and this. It doesn't work. It's a scam. They're completely the other way. You can see both polarities. Here's the truth. When you are trading one-to-one reward to risk, the number of opportunities will allow for a 50-50 probability of success, right? Now, when you are trading a market like Forex, which over time pretty much eventually cancels out, it goes nowhere, right? It just ranges and it goes sideways. That means that you are dealing with an underlying edge of 50%. So the true distribution of winners and losers, it will look a lot more like a bell curve. So when you take a small number of trades, just like the coin toss experiment, the results are going to be completely sporadic. They're going to be all over the place. So the chances of you stringing together, 4 or 5 losses or maybe 4 or 5 wins in a row is pretty high. And you'll be in the tail ends of the curve when the number of trades that you have taken are really low. But as you take 10, 20, 50, 1,000 trades, over time, the law of large numbers starts to kick in and it returns to the expected value of the underlying 50-50 edge of a one-to-one risk to reward. So anywhere on the area over on the right-hand side is irrational. So it's completely irrational to think that you can win 100% of the time, right? Because if you took the exact opposite side of the trade, then you'd lose 100% of the time. So then likewise, if you think that you've got a 0% probability of winning, right, and you think you just can't win no matter what, and you're going to lose 100 times in a row, that's obviously irrational thinking because it's just not possible. Go and lose 100 trades in a row with a one-to-one reward to risk and show me the data. If it was that consistent, then all you would have to do is flip to the opposite side of the trade and you would win 100% of the time. But either are lopsided perceptions that people bring into the market. People just bring their own stuff into the market. And if they're all the way over there on the left-hand side, they're projecting, I can never win, then they're skeptics. If they're up this end projecting I can never lose, then they are naive. But mastery is in the middle. If you log into your brokerage account and you hover your mouse over the buy button and you close your eyes and you just kept randomly clicking the buy button, whenever you felt like it, trade, 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 every single minute of every single day until the end of time, with a fixed one-to-one RR, you will win 50% of the time and you will lose 50% of the time. You will have some trades which form your winning streaks on the right half of the curve, and you'll have some that form your losing streaks on the left half of the curve. But trading an infinite number of positions every week, it's not really practical or realistic, is it? And the transaction costs will start to add up rapidly. So what our job as master speculators, as photon traders, is to find an edge by pulling the quantity of trade setups down, by filtering out infinite possible potentials with layer upon layer upon layer of filters. So we're basically using filters with technical confluence to filter out the infinite possible amounts of trades. So that way we're not trading infinite times a month because we are building a portfolio of evidence of technical confluence to make sure that we filter out trade setups so that we are left with just high probability opportunities so that we are stacking probability on our side. So then that when we do this, we end up on more like 10 to 20 positions a month or a week, depending on if you're more of a day or a swing trader. And then down here at these amounts of trades a month, that means that we can actually logistically sit at our computers and take those positions. 10 to 20 trades a week or a month, that is much more practical and possible. Infinite trades, obviously not so much, because the only person who gets rich in that situation is your broker. So now when we sit down at our computer and we have completely changed and improved our probability model to one that approximates around this ballpark, and then we still have a bell curve, because even the best traders in the world, they are still going to have periods of winning streaks where they seem not to be able to lose, and then they have periods of losing streaks where they tend to lose more often than they win. But this is a bell curve, and this is what a profitable trading edge looks like. That is what it looks like. So if you want to take the whole demographic of traders worldwide, 90% of them are either green or red. They're either really naive or they're really skeptical. Off the radar, completely off the chart. Whereas the professionals are doing this. There's a reason most people are off the map and off the radar, and it's why we have placed such a massive emphasis on and spent time breaking down trading psychology and what it means to Trading Edge. It's why we stress so much importance on it. You really have to break down any naive fantasies that you may have or any of your irrational doubts and fears, because people tend to bring in things from their lives into the market. The traders who are already successful, but they don't even really know about any of this stuff, so they just happen to be very balanced individuals from the start. And they don't even realize actually what's really going on here, behind the scenes with other people who do have good analytical skills, but they have completely different diverging results to them due to their judgments, infatuations, naiveties, and skepticisms about trading and what trading means to them. Because when you can break through all of those, it makes a massive difference to your trading performance. So, going back to this diagram, the real objective truth is in the middle. Find an edge by using layers of technical confluence to reduce the infinite number of trade entries down to a much more manageable amount of trades per month, or week, and then you can change your bell curve to have a much higher probability of success. Now, another massive factor that plays a role in why not everyone who has a good strategy that holds a profitable edge are not making money is due to their risk preference. So hopefully you've watched the first episode in this module called Are You Destined to Fail? And you will know that one of the reasons people find it so difficult to stick to their trading strategy is because the human mind is not wired to think in terms of probability. Rather, it's designed to think in terms of survival and self-preservation. Biologically, our brains are built around fear and the avoidance of fear as a survival mechanism. It does not perceive risk, only threat. So the emotional survival brain, it's incapable of distinguishing between real biological fear and the psychological discomfort of risk. But the essence of successful trading is risk management. That's all we're doing to make money. It's a process by which we assign levels of risk so that our odds of profitability are higher than our odds of loss over time. And on a longer time horizon than which our emotional brain was built to manage, consistent and profitable trading becomes possible with good risk management. However, to the short-term immediate focus of our emotional brain, all risk is a threat to our imminent survival. To the untrained brain and mind, any triggering of threat automatically produces a biological fear response from our primitive brain. And you can see this when you speak to people about their preference on risk-taking. So I ran this survey on my Instagram story a few months ago where I asked those who follow me a couple of simple questions. And I asked, would you prefer A, a sure gain, a guaranteed gain of £700, or B, a 75% chance of gaining £1,000, but a 25% chance of gaining absolutely nothing? So what I want you to do is just take a few seconds to think about those options, pause the video if you need to, and then write down and take note of your answer of either A or B. Okay? Then I asked them a second question. Would you prefer a guaranteed loss of £700 or a 75% chance of losing £1,000 and a 25% chance of losing nothing? Again, take a few seconds or pause the video just to decide which one you prefer in this situation and write down your answer. Okay, so after the survey was up on my Instagram story for 24 hours, I looked at the results and 81% of people chose option A, with 19% of people choosing option B. So was your answer with the majority or the minority? So the majority of people chose a guaranteed gain of £700 over the 75% chance of gaining £1,000 and a 25% chance of gaining nothing, because humans generally tend to be risk avoiding when it actually comes to gains. The reason why that is because once we have something, the majority of humans are violently opposed to risk losing it. We want to hold on to it. And that's why the majority of traders, they take their profits and they run away too quickly when they're in winning positions because they can't handle the pain of potentially giving back the profit that they can feel in their hands. They don't want to give that back to the market. So now in the second scenario, only 16% of people chose option C, and so 84% of people chose option D. So 84% of people chose the option of taking their chances of potentially losing a bigger £1,000 loss, or with a much smaller chance of potentially losing nothing, over the choice of a guaranteed smaller loss of only £700. Now the majority of people chose option D because they tend to be risk-seeking when it comes to losses. They would rather risk a possible big loss in preference to suffering a certain guaranteed moderate loss. And this is how gamblers get hooked. Once they've made a loss, they just keep gambling and gambling. Sometimes there's even larger stakes in trying to avoid realizing the loss. It's the same way when many traders will take a loss or two in the morning. They are much more likely to keep trading that day because there's no way they're going to go to sleep that night with the pain of being in drawdown. They're going to try and force their will in the market by taking more risk on poor setups to try and get rid of that pain. So in both of these questions, the majority of people answered the way they did because it all comes down to avoiding pain. Your primitive animal brain is just trying to avoid pain and protect you at all costs. And remember, it views all risk as a biological threat to life. But now that you should know how to calculate probabilities and calculate the profit expectancy of each decision, you will find that options B and C are actually mathematically better decisions. The profit expectancy of option A, so a sure gain of £700, is obviously £700, but for option B, it's actually slightly higher at £750. In the second scenario, the guaranteed loss is £700. It's actually the better decision because as option D has a profit expectancy of minus 750 quid. Now, although in both scenarios the difference is only £50, it may seem like that is not enough reward to refuse a certain gain of £700 in a one-off trial. Fair enough. However, in trading, you're not going to only take one trade, are you? So over a large sample size of trades, you have to think in terms of probabilities, as that small difference of £50, that's rapidly adding up, as you compound and start to scale your account. It's basic human nature to prefer immediate gratification over delayed gratification. However, if you start to employ your primate instincts in the market, it's pretty much a sure way to lose your money. So the hard part here is retraining your subconscious mind to recognize this and to start taking action in line with probability. Now, naturally, this does come with time and experience, and these principles are not exclusive to trading. In fact, many successful entrepreneurs and businesses, they use this structured thought process in their decision-making processes each and every day. So, how can we start to think as successful traders then? Well, let's take a look at two mental models that we can use to apply to our trading. The first of which is what I like to call the macro versus micro. So we know that if you focus on each trade individually, there will be a random and unpredictable distribution between our winning and losing trades, right? We have no idea what sequence our winners and losers will fall in, just like the roulette table. But on a collective basis, just the opposite is true. If a large enough number of trades are taken with a profitable edge, then patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. But here's what makes thinking and probabilities so difficult, because it requires two layers of beliefs that on the surface seem to contradict each other. We'll call the first layer the micro level, and at this level, you have to believe in the uncertainty and unpredictability of the outcome on each individual trade. And the second layer is the macro level, and at this level, you have to believe that the outcome over a series of trades taken is actually relatively certain and it is predictable. Now remember the law of large numbers? You need to perform a large number of trials for the true underlying expectancy, so the true edge to play out. But at the start, it's very volatile and unpredictable, right? You could first start off in a drawdown for a while, or maybe on a hot winning streak, but at the start, it's all pretty much down to luck. But it's the ability to believe in the unpredictability of the game at the micro level and simultaneously believing in the predictability of the game at the macro level that makes the casino and the professional speculator effective and successful at what they do. Because they have learned and have completely accepted the fact that they don't know what's going to happen next. And more importantly, they don't need to know in order to make money consistently. They don't care. And because they don't have to know what's going to happen next, they don't place any special significance, emotional or otherwise, on each individual hand, spin of the wheel, or roll of the dice. In other words, they're not restricted by their unrealistic expectations about what is going to happen when they are sitting in a trade, nor are their egos involved in a way that makes them have to be right. They do not attach their own self-worth to the outcome of an individual trade that they take. So as a result, it's much easier to stay focused on keeping the odds in their favor and executing flawlessly, which in turn makes them less susceptible to making costly mistakes. So they stay very relaxed because they are committed and willing to let the probabilities, their edges, play themselves out and just let the numbers fall as they want to. All the while knowing that if their edges are good enough with strict money management and the sample sizes are big enough, then they're going to come out net winners in the long run. So don't try to predict or know in advance the outcome of each individual event, because aside from the fact that it would be extremely difficult, given all the unknown variables, It's just not necessary to create consistent results. All we have to do is keep the odds in our favour and have a large enough sample size of trades so that our edges have more than enough opportunity to work. Now, Mark Douglas, in the book called Trading a Zone, which I'm sure many of you have heard of, says that to think in probabilities, you have to create a mental framework or a mindset that is consistent with the underlying principles of a probabilistic environment. A probabilistic mindset applicable to trading consists of these 5 fundamental truths. The first truth is that anything can happen. Literally anything can happen at any point in the market or on any given trade. There are always unknown forces operating in the market at every moment, meaning at this moment, in this trade, anything can happen. And when you accept that truth releases you from the expectations of what you think the market should or should not do. Truth number 2, you do not need to know what is going to happen next in order to make money. So when you're sitting in front of your screen, watching price move, don't be thinking what ifs, instead think if then. So don't sit there thinking, what if price does this? What if price does that? Instead, you want to be thinking, okay, if price comes to this level and it does X and Y, then I'm going to do Z. But if it goes to that level and it does A and B, then I'm going to do C. Right? So have a plan for everything. You want to get 2 steps ahead of this stuff. So that way, you're not wasting energy on trying to predict what price action is going to do next. Instead, you just react and you have a plan for every situation. So you look at your plan and you see that nothing meets your criteria, then you just sit on your hands and you do nothing. This means you're being patient with confidence rather than hesitating out of fear. It's a subtle but extremely important difference. And then when you look at your plan and you see your criteria has now been met, then you can execute without emotional interference. Okay? So make sure you're in the mindset to react instead of trying to predict. And the third truth is that there is a random distribution between wins and losses for any given set of variables that define an edge. So in other words, based on the past performance of your edge, you may know that out of the next 10 trades, you can expect on average that 6 will be winners and 4 will be losers. But what you don't know is the sequence in which those wins and losses will occur. What you also might notice in this illustration is that although it's based on a 60% strike rate, in the reality example, there are only 5 green ticks there. So only 5 winning trades, when you think that maybe there should be 6, right? But this is because although you have a 60% strike rate, it could take 30, 50, maybe even 100 trades for that underlying expectancy to show through. So with a 60% win rate, you can still have 7 or 8 losers in a row. And so many people just don't get this, or they just don't accept and remember it. Now, another thing we need to consider is that not only do we not know the sequence of our wins and losses, but we also don't know how much money the market is going to make available to us on our winning trades. Trading truly is a probability game, and you have to have that long-term vision on the numbers rather than getting lost in the short-term volatility. So when you understand that every loss puts you that much closer to a win, you'll be looking forward to the next occurrence of your edge. You'll be ready and waiting to jump in without the slightest reservation or hesitation, because you really understand that it's a probability game. But if you still believe trading is about being right or wrong, then after you take a loss, you will anticipate the next trading opportunity with fear and anxiety. You're going to be sitting there nervously looking at your screen, wondering if it's going to work. And this will then cause you to start gathering evidence for or against taking the trade. If your fear of losing is greater than your fear of missing out, then you will start to look for any information you can find as evidence against taking the trade. You'll be looking for technical reasons that maybe are not even part of your strategy in order just to justify not taking the trade. But on the other hand, if your FOMO, your fear of missing out, is greater than your fear of losing, then you will gather evidence in favor of taking the trade, and you may actually be, subconsciously blinded to valid reasons of actually why you should not be taking that trade. In either case, you will not be in the most conducive state of mind to produce consistent results. And that's why we strive to remain neutral as possible and look at everything through an objective lens, so we're not blinded by fear or greed. You have to completely accept the fact that you don't know what's going to happen next. No one does. If you expect to know what happens next, what that means is you are projecting your expectations of what you want to happen onto the market. Nothing else, and I mean nothing else, has the potential to create more unhappiness and emotional misery than an unfilled expectation. So you have to neutralize your expectations about what the market will or will not do at any given moment or in any given situation. Now, what this means in more practical terms is that when you enter a trade, you must have already accepted the risk of that trade losing. So you are essentially paying the market to find out if your trade idea is going to work or not. And that small risk you take on is the price you pay for your potential reward. Now, the fourth trading truth is that an edge is just a higher probability of one thing happening over another. So a pretty simple and self-explanatory one, to be honest. But the only thing that I would kind of personally argue, or I should say maybe change about this truth, is that your edge doesn't have to be greater than 50%, right? Remember, strike rate alone is irrelevant. You need to combine the strike rate with your average P&L per trade so that you know your profit expectancy, as that is your true edge. So your strategy may have a lower probability of winning than losing, but when you win big, and when you lose small. So your winners make up for your losers and more. And the final trading truth is that every moment in the market is unique. We have our strict and clearly defined setups in our rules-based trade plans, right? The setups have the same criteria that we look for, and we execute them the same way over and over and over again. But every setup that you see and take, and every bit of price action, it's never exactly the same. It would always be slightly unique in one way or another. And in its uniqueness, the market is just simply communicating in probabilities. No one knows what the probabilities are exactly because for every trader, they are different. Therefore, you can't expect to be right that your edge or setup will play out because it's only yours and not everyone's definition of an edge. Now, when you achieve complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with trading will end. When you adopt these 5 truths, your expectations will always be in line with the psychological realities of the market environment. And then once you have those appropriate expectations, you will then eliminate your potential to define and interpret market information as either painful or threatening, and thereby you effectively neutralize the emotional risk of trading. That is how you evolve towards the light. That is how you become a photon trader.